Hello everyone, Clifford Bennett, Chief Economist at ACY Securities, and we have just had one of the biggest developments in the entire history of the United States because over the weekend, in fact over the last 12 to 18 hours, basically Department of Treasury, FDIC and the Federal Reserve got together and decided to entirely change the US government's policy on bank deposits, coming up with a new program in a matter of hours that now guarantees all depositors at all banks the security of those deposits to their full extent. How did that happen without the approval of Congress? So there could be rocky, very debating days ahead as to whether this program will actually stand beyond the immediate crisis. On the surface, markets have taken this as good news. We all knew that there would be action from these organizations to resolve the issue. Why they have gone to such lengths, though, is the real concern. It says loud and clear that all three organizations feel there is risk of systemic failure in the US banking system, clear and present immediate danger thereof. The Fed quietly announced, Janet Yellen quietly announced that yet another bank has just been closed down and gone under. The New York Signature Bank has just ceased to exist as well. So that's two banks in one weekend. And we're supposed to go, okay, but everything's fine now, right? Because depositors' accounts are guaranteed. Well, it may not stand, plus it's a panic move suggesting things are far worse than any of us thought. It also means that executive management teams, boards of directors, they don't have to care about the security of their depositors' funds anymore. They can go and take risks, and if it all goes into crisis, they can parachute out and the depositors will be okay. So depositors don't have to care about who they bank with anymore. They don't have to bank with the safest bank. They can choose any bank with any high level of interest rate to go and bank with because the federal government now guarantees their deposits. This is the biggest step yet by the United States to adopt the China economic system of state interference in a capitalist process. So large, significant daily state intervention in supposedly a laissez-faire economic system, which of course it hasn't been for some time. But that's what we're seeing here. This is huge. This is a huge historic development. It's not at all capitalism. Far from it. It's the exact opposite. It also means that should a bank get into trouble in the future, and these two of course, that they have to give their highest quality assets, hand them over to the federal authorities. So in any receivership process, the government gets the best assets from that bank. This is not capitalism at all. What is going on? It is interesting that Janet Yellen used the term due to systemic risk when closing Signature Bank New York a few hours ago. During the week previously, Janet Yellen had said that she was closely watching, the Department of Treasury was closely watching several banks, monitoring them very closely. She had concerns for several banks. So this may not be over yet, and depositors may get their money back. But how do we feel about a banking system that is facing systemic collapse? And we've basically been told so by the authorities, which is why now they're going to seize all the best quality assets of any bank that gets into trouble and at the same time guarantee depositors' funds without limit. I don't think this will still be around in a month, 6 weeks' time. I think Congress will close this idea down. Because it goes against everything the United States economic system is supposed to be about. And it's a carte blanche for banks to be as stupid as they want and as carefree as they want and take as much risk as they want. So this is really, I think, a major systemic error in the face of systemic risk. I put out a report earlier today and over the weekend, Saturday morning, I've been saying this since, that there will be no more Fed hikes. Not while this is going on, certainly. And this could dampen sentiment. It's all very well that depositors' funds are transferred, but the whole world's now nervous about the US banking system. I would say that the cost of borrowing for most people is going to go up because of this, even without Fed rate hikes. So I think the Fed is probably finished for the moment. And remember, we were the most hawkish in the world, forecasting 5.75 to 6.5% over a year ago as our target range, and everyone thought it was crazy. Now everyone has the same target range. But we're probably the first to say the Fed's actually not going to hike at the next FOMC. That would be irresponsible given the situation in the US. So, and the Fed is capable of doing irresponsible things, but I do think they probably will be on hold. Now, if everything were to stabilize and everything would be completely rosy by the following FOMC, which looks unlikely at this point, and inflation was staying high and continuing to accelerate, they would again be hiking interest rates, but probably by 25 points. So instead of 50 to 75 points at the next two meetings, we're probably going to have 0 to 25 points. So that will help equities lift for the moment. The idea that the regulators have solved all the problems of the banking industry risk overnight will slightly buoy equity markets, but I don't see it being sustained because people are just going to begin to scratch their heads like I have and say, what the heck is going on here? This must be really bad. This is a full-blown crisis. This didn't even happen in the global financial crisis. Federal authorities didn't do this. So something's really amiss in the US at the moment. And therefore, people are just going to think about their own personal portfolios, their own funds under management and go, should I be risking on this? Maybe some fund managers are going to be buying, but I think a lot of individuals are going to be saying, oh, I'd rather get out and watch for a while. So I do think there could be a momentary rally in equities, but it may not last. I do think the US dollar can come under pressure. The idea that it's okay to safely buy the US dollar again now because of this regulator intervention, I think it has a shelf life of 3 to 18 hours. And then more likely people are going to realize that the United States is a country that used to be by far the largest economy in the world. Now it's one of three: US, China, European Union. And it used to suck in all of the world's capital. 72%, I think, was the peak of in any one year how much capital, fresh available investment capital in the world went to the United States. Now I think it's about half of that and probably falling. So things have really changed since the US dollar was indeed the safe haven currency, reserve currency of the world. And things are changing much faster than the Federal Reserve is aware of or will give credit to. Some recent testimony by Powell suggested just last week that he thinks, yes, the US dollar is perfectly safe as the only reserve currency. And of course it's not. I gave a speech at APEC in 2012 and I said it's going to be 3 equal reserve currencies, Euro and US dollar. And I was the first to say it in 2011, thereabouts. And gave that speech at APEC, and people have written about that since. So I think the Fed's failing to see what's really going on here. And I gave a speech in Miami in 2012 as well, and I said to the top 600 CEOs, not CEOs, chief financial officers of the top 600 corporations in America, I said, you need to adjust your business to be delegated globally because the world has shifted from US-centric to regional economic zones, and you need to delegate decision-making into those zones so that you can respond quickly to market circumstances. The Fed is not recognizing this change, that it is now one of several, and will increasingly be one of several. So we have a US dollar where the Federal Reserve doesn't fully understand the long-term historical shifts taking place in the global economy. And we have a situation with massive trade deficits, massive fiscal deficits, a Congress situation where an actual debt default by the US is threatened and could occur. I tend to think it won't, but I think the risk is a lot higher than some people are saying. And we have falling property markets, falling bond prices generally. They've had a bit of a bounce today. Falling equity markets, a housing industry that's in recession, a manufacturing industry that's in recession. How is this a currency that you really want to hold? And the only reason was that the Federal Reserve would continue raising interest rates. Oh, and the US is the safe haven currency. And there's been a bit of a pin pushed in that bubble over the last few days with SVB, now signature, now this policy change by federal regulators, which may not hold up in the US Congress upon review, but is there for the moment. People are going to say, if the Fed's not going to be raising interest rates, why do I want to be long US dollars? So I'm happy on the day of my trading to go with the range breaks, whichever way they go. But can I just say, from a step back, fundamental scenario, we could have just seen or be at or be near a long-term historic top in the US dollar. And as for the equity market, a whole lot of people on the day are going to be all excited about buying the dip and it was just a storm in a teacup and we should take advantage of the opportunity to dip and buy. Well, the market was falling before any of these developments. So the market was already rolling over anyway under the weight of other factors. So I think that combined with these events, the turmoil of these events, means that there will be people waiting in the wings to sell any US equity market rally at some point. And I would just suggest that that point is sometime in the next 6 to 36 hours. So probably by the end of Monday trading in New York, but certainly by the end of Tuesday trading in New York, I expect to see a resumption of significant selling pressure upon the US stock market. And that of course will flow through to the sentiment in other markets, particularly Western markets around the world. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.